All right, hey everybody, it's Luther Wilson III, representing for Upside Property Services, real estate broker, real estate investor here in the Kansas City market. In today's video, I want to talk about real estate finance, private capital, and gap funds in relation to how real estate investors can utilize capital. All right, so as a lot of you know, if you've been tracking, you know I do real estate as a realtor, as a broker, as a practitioner, if you will, here in the Kansas City market. Been at it for on and off since 16 years ago. So did my first deal in 08, bought my first house in 09, and it's been a process or a journey, if you will, since then. Lots of ups and downs, and lots of learning and lots of growth. And so over the years, I've just spent a lot of time working with investors, trying to figure out how to effectively place capital, all right, in order to grow a portfolio. So from the beginning, I always knew that I wanted to have investments that pay me each month or each quarter. And I knew I wanted to do that in real estate somehow, and wasn't sure how that was going to happen. And of course, over time, things change. The value of properties, the cost of money, the cost of labor, material goes up, and then we experience market shifts and so on. And so today, it's August 12th, Monday, August 12th, 2024, second half of the year, and things are different. And there seems to be more concerns or fears about what's to come, all right? And so hopefully in today's video, and some of the previous videos that I've done, and some that I plan to do in the future, it'll give you an idea of how you can make that happen if you are looking to invest and grow a portfolio with yourself. All right, so big factors is the capital and access to capital and the ability to borrow. Okay, so I'm gonna just go over some of the basics when it comes to real estate financing, private capital, gap funds, and how I want to dive more into how investors can utilize it in today's market. Okay, so when it comes to the real estate finance for investors, you got qualified mortgages and then you got non-qualified mortgages. All right, you also can utilize seller financing. All right, so each of those forms of long-term financing, there's subsets of them. So I don't want to dig too deep, but those are the main things, or the main ways that investors can use financing. All right, qualified mortgages, non-qualified mortgages, and then you have seller financing. All right, when it comes to the private capital piece, all right, and something that I share with clients and colleagues, and after doing a number of deals myself with partners and digging in deeper with people around me, I realized that all of the investors that are buying and renovating properties, whether they're using a fix and flip strategy or they want to refi and keep the property, all of the investors that I know that have done multiple deals are using some form of private capital. All right, and the way I see it, private capital can be your own money. Okay, it could be money from friends or family. Okay, and it could be money from an associate or a business partner. So that, how I see private capital. So even if it's your own and you're using it to invest and do your deals, I still consider that private capital. All right, so that, again, there's different variations. You got short-term debt, there's the long-term debt, you got second lien position debt, and on and on and on. So I want to just cover some of the main things, all right, and again, talk about how investors in today's market can utilize it. All right, so talked about real estate finance, talked about private capital. all right? And then the gap funds is key, all right? So I was talking with a buddy of mine on the phone last week, and I was like, man, the gap funds are critical. Like, we were just chopping it up. I'm helping him sell one of his investment properties. And I'm like, man, something that really stuck out to me is gap funds. A lot of investors aren't talking about it. What's the deal? Why aren't they talking about it? And he's like, gap funds, what do you mean? I'm like, it's the funds that you need to fill the gaps. And he's like, oh, the gray money. He called it gray money. So I thought that was really neat. So if you're listening or watching this video and you know who you are, I won't say any names, but appreciate you bringing another term to my mind. So you got gap funds or gray money, the funds that help fill the gaps. All right. So when you're using the real estate funding, real estate loans, and you're using private capital, however that looks, all right, there's going to be gaps. There's going to be, the lender or the first lien position holder, all right, when you borrow money, there's a first lien position holder, all right. More often than not, they're only going to loan a certain amount. They're only going to leverage, or they're only going to give you so much. It's probably not going to be the full amount for the purchase, rehab, down payment, closing costs, holding costs, and all that. Like in most cases, all right. And hopefully this inspires some of you to dig a little bit deeper into this, because it's so important. Again, a lot of us, we get taught, we're so obsessed with finding the deal, yet we don't put as much emphasis on the capital piece. It's so critical. So that's something I want to stand on the mountaintop and just yell out, is like, look at the capital piece, look at the funding, all right? Especially if you want to, purchase and keep these properties and build a portfolio that'll produce revenue or cash flow each month, each quarter. So important. All right, so the financing, the first lien position debt, that lender, whether it's a qualified mortgage, a non-qualified mortgage, if you're doing seller financing of some type, or if you're using private money, they're gonna usually loan maybe 60 to 70% of the appraisal amount, or 60 to 70% of the after repair value, the ARV, okay? In some cases, they may do more. They may do 70 to 80%. In some rare cases, above 80% loan to value. So that, 70 to 80% in first lien position, right, of the current value, or the after repair value, or the appraisal amount. Then you got to figure out the rest of the money, that additional 40 or 30 or 20%. That's where the gap funds come into play, or the gray money, okay? That's where I've spent a lot more time analyzing and trying to figure out how me and my clients and my partners can raise that money, or generate that money, or maybe even borrow that money for those gaps. Very important. And okay, so the two main things that investors do, right, when it comes to investing in general, you got buy and hold, you got fix and flip, right? A lot of times investors are going to use hard money loans. In some cases, they may have, friends and family, associates, business partners, so on, for the gap funds to cover, that first lien position debt. But a lot of cases, most investors are going to use a hard money loan or some type of short-term debt, okay? And it's only going to cover so much, all right? So if, let's say you're going to do a fix and flip project, all right? Because that's what most of us think we want, right? You're going to do a fix and flip project. You don't even have an LLC together. You don't have the gap funds, but since we're taught this, you're going to go find a deal first, right? So you're searching, you're talking to realtors, you're talking to wholesalers, maybe even doing your own direct to seller marketing campaign, right? However that looks, and then you find an opportunity. You find what you think is a deal, all right? And you even get to the point where you negotiate with the seller. you agree on the price and the terms, and you go under contract, all right? Then from there, maybe you have your funding lined up, maybe you have the lender. In a lot of cases, investors don't even get that far. I've seen it time and time again. So I'm encouraging you to look at the financing first. So in that case, the investor or wannabe investor, I don't even know if we can call them that, they negotiate with the seller, they agree on the price and the terms, they go under contract. They don't even have an LLC, they don't have a pre-approval letter, but they're going under contract. They're promising to the seller, they're agreeing to give the seller X amount on X date, and then they're gonna go look for money. They're gonna go hunting and they're gonna go scrambling around. Maybe they could, find the money somehow and they can close, or a lot of people may have an assignment clause in there or out clauses in there. If worst case scenario, maybe they could assign it. Actually, that's not even worst case scenario. Worst case scenario is you lose the deal, which happens probably more often than people want to talk about. That's a whole other story. So you go under contract, right? You're trying to find the money. You find a hard money lender. There's plenty of them in town. Any city you're in, there's probably a private money lender or a hard money lender that might be willing, if the numbers are decent, to loan you money on that deal, okay? And they're gonna say, oh yeah, we got 100% of that. We're gonna do 100%, right? So we don't even know what that means, right? So you go to close, let's say the numbers make sense. On paper, the purchase and the renovation, you can be all in at 70% of the after repair value, and you find a lender and you go to close, and the lender, wires the money to the title company. You get it done. Then what? You gotta figure out how to get through that renovation project. So even though you got the deal, you got the funding from the lender, it's a hard money loan or a short-term loan, they agree to do 100%. Maybe you didn't ask the right questions. Maybe they didn't dig too deep into how this actually works. Now you got to get the renovation done. How are you going to get the renovation done if you don't have the gap funds? You see what I'm saying? That's where a huge gap funds is so key for most investors, wannabe investors, right? I don't even want to call that investing. I don't know what that is. It's speculating. It's gambling with real property, basically. Anyway, so the gap funds, you got to figure out how to get through the renovation project. That's why the gap funds are so critical, especially in today's market and any market you're in across the US. Things cost more. The money costs more, the labor costs more, okay, and the properties cost more. So you got to figure that out, right? So that's the short-term debt if you're going to do rehab projects. The same thing applies if you're going to rehab and refi. A lot of people want to try the BRRRR, buy, renovate, refi, rent, repeat. Same thing applies. If you're going to use short-term debt and you think you found a good deal, you got to figure out, okay, my lender may get the closing done. I don't have to bring anything to the closing table. That's going to cost extra probably. Then you got to figure out how to get through the renovation. Because I feel like I need to do a whole video just on the renovation process when you're using, even if you're going cash or if you're using financing. So you're going to have to negotiate or work it out, or if you're handy or if you're a contractor or GC, somehow those renovation costs, the labor and the material for at least the first part, second part, and maybe even the third part of the construction or renovation project is going to have to be fronted. All right. So you now own a property, you got hard money on it, you got 6 months to get through the project and refi, or get through the project and resell. So you just put a lot of pressure on you and your lender and your partner, whoever's involved, and you may not even be aware of it. So you got to figure out what contractor you're going to hire, because we know you didn't do that beforehand in most cases. So you got to figure out which contractor or how you're going to get the first and second draw maybe even continue forward, how you're going to get that fronted. Because when you get through the project, right, then you can get reimbursed from the lender. Okay. There's so many different things. It's so risky. That's what I'm getting at. All right. So the gap funds are key just to get through the project. We know that more often than not, we're going to go over budget and past the deadline too. So you got labor and material. Okay. The insurance for the year probably was handled at the closing, maybe not. So you got labor and material, you got insurance, you got holding costs, which may include utilities, and then lawn care, exterior type of care, snow removal, whatever, during the holding renovation period, okay? And then a lot of times the lender's gonna charge you monthly interest payments that aren't gonna be deferred, so that's gotta come out too. So you got labor, you got material, you got insurance, you got utilities and holding costs and lawn care and snow removal, whatever exterior stuff needs to be, taken care of. And then you got the monthly interest payment to that hard money lender on top of that. Does that, okay, I hope this is clicking with some of y'all, all right? Because it does not get talked about enough, which is why I'm doing these videos. I need to do more of these to talk about this stuff. This is the reality of real estate investing. You want to flip houses, you want to rehab houses, this is it. You got to figure this stuff out, okay? So you're going to be bleeding money. You're going to be hemorrhaging more or less. You got all these costs going out every single month, and you're under the gun to get the project done and refinanced or the rehab done and the property resold within 6 months. And then your lender may extend it out. If you work with me and my team, okay, my lender, my broker, maybe get you 12 months, but you still got to qualify for the loan. All right. So just think about this stuff when you're looking, before you are looking at deals, ideally. Okay. Odds are most of you won't do it. Maybe some small percentage of you will, but the gap funds again. So that's just on the short-term funding for properties that you purchase with the intention to rehab and resell, or renovate and refinance and keep, which I hope most of y'all are planning to do, because you did all that and you stressed out for months on end, and now you're gonna sell the property. And you might walk away with a few $1,000s or break even and lose money. You might get lucky and make 5 figures, but it's gonna be luck, okay? Damn near a miracle at this point. I hope that makes sense. So that's just on the short-term side. And why now in 2024 more than ever, I'm pushing investors to look long-term. Houses, you can do apartments if you want. My bread and butter, as a lot of you know, I talk about it regularly, B-class single family homes, buy them, hold them, keep them for the long term, all day, right? So there's still, when you look at the financing and being able to acquire and keep whatever type of property you want to keep, you got gap funds, even for the purchase, and if you're going to use even seller financing, but if you're going to use a qualified mortgage or non-qualified mortgage, okay? So non-QM mortgage is 30-year fixed rate mortgage is what I consider the gold standard. That's what we're shooting for every single time for various reasons. I can get into that at a later video as well. But that, again, the lender on the qualified mortgage or non-QM loan, in a lot of cases on a seller finance purchase transaction, you're still going to need to come up with some type of money for the down payment, the closing costs. You might have commissions to pay. And then, the house or the property that might be vacant. My preference is I want to buy properties that are vacant. So if you buy the property, it's vacant, single family home, B-class in and around Kansas City, holler at me, we can make that happen. But you got the down payment, you got the closing costs, and you got utilities. And then again, lawn care, snow removal, exterior work, however that looks. Then you got the mortgage payment until you get the property rented or occupied. All right, so huge on a single family home, on non-qualified mortgage, okay, you're looking to put 20% down. maybe more, maybe 25 to 30%. You could put a larger percent down, which might be another plug or play as well. If you're putting 30 to 50% down and you have access to gap funds, that private capital, again, you can make that happen all day long. All right. So plug in with me. Like that's real estate financing for investors. We touched on private capital a little bit, and we touched on gap funds. All right. So as much time as we spend looking for deals, I'm encouraging myself, us, you, to look at sourcing, raising, generating, figuring out the gap funds along with the real estate finance piece. If you spend as much time, or at least a small amount of time, while you're looking at deals, while you're building relationships with your contractors, while you are figuring out your market, however that looks for you, huge, huge, huge. So tying that in together, the real estate finance, the private capital, and the gap funds, along with a real estate investing model, or whatever real estate investing strategy that you think you want to deploy, putting that all together somehow to be able to acquire, renovate, keep, maintain, manage these properties is huge. So if you want to learn more about that, plug in with me. It's Luther Wilson III. Subscribe, give me a like. My handle on YouTube as well as Instagram is Luther3RE. You can look me up, Luther Wilson III. Active on Facebook and LinkedIn as well. And let's set up a consultation. I'd be happy to talk shop with you, and I'd be happy to share with the experiences, how we're making it work right now in today's market, what we're doing in and around Kansas City. You can do it in various markets, okay? And, plug in, again, like look long-term. If you can, figure out the financing, get your model, your investment strategy on point, and hit me up. I'll be happy to share with how we're making it work. All right, thanks for your time. Peace.